AS-2 Valuation of Inventory. So let's see the definition of inventory. Inventory is an asset held for sale in the ordinary course of the business, in process of production for sale, and materials or supplies to be consumed in the production. So what is an inventory? Inventory is an asset which is held for sale in the ordinary course of the business. That means finished goods. Now, in process of production for sale, it is in the process of production, that is work in process, and materials or supplies to be consumed in production, it denotes raw materials. So inventory means finished goods, work in process, and raw materials. Now let's see what is out of scope of AS-2. What doesn't comes under AS-2? First one, work in process under construction contract. It doesn't comes under AS-2. It is dealt in AS-7. So work in process under construction contract, work in process for security service provider. Service providers means like what? Software developers, medical, CA, that's all service, right? And it's also intangible. So it is not an inventory. It is not dealt in AS-2. Now shares, debentures and other securities held as stock in trade. These are dealt in AS-13. Now livestock, agriculture and forest product, and mineral oils, ores and gases measured at NRV. They are not inventory and are not dealt in AS-2. So these are out of scope of AS-2. Now let me ask you a question. Is cow an inventory? Then what about milk? So cow comes under a livestock, right? Cow is a livestock, and livestock is not an inventory, but milk, it comes under inventory. So these points need to be noted. Now let's see the measurement, how to measure inventory. Measurement can be done at cost or net realizable value, whichever is less. So there are different type of costs: purchase cost or direct cost, cost of conversion and other costs. First let's learn about purchase cost or direct cost. So what is that? Purchase cost, in the name itself we have seen what amount did we pay. So that includes the payment to buy the product minus we will reduce what? The trade discount will be reduced, and non-profitable taxes will be added, and all other direct expenses when added gives the purchase cost or direct cost. So the first type of cost is purchase cost or direct cost. It's the amount that we paid minus the trade discount plus the non-refundable taxes and all direct expenses. Then we will get the purchase cost or direct cost. Next one is the cost of conversion. So the name conversion itself comes in manufacturing entities, right, where the raw materials are converted into finished goods. Now what are the cost of conversion? There are two: labor cost and production overheads. Labor cost and production overheads. And the production overheads is further divided into fixed overheads and variable overheads. So what are fixed overheads? How will we allocate the fixed overheads? If the actual capacity is more than the normal capacity, on the basis of actual capacity, we will allocate the fixed overhead. We will discuss this in question. First, let's learn it. So, for production overheads, there is fixed overhead and variable overhead. And the fixed overhead itself, how will we allocate? If the actual capacity is more than the normal capacity, we will allocate the fixed overhead on the basis of actual capacity. And if actual capacity is less than the normal capacity, we will allocate the fixed overhead on the basis of the bigger one, the normal capacity. Now variable overhead we will allocate on the basis of actual capacity. So this is one cost, and there is one another other cost. Other cost is like selling and distribution cost, cost of design. These are the different type of cost. Now let's see what are NRV, net realizable value. How to find the NRV of finished goods, work in process and raw materials. So NRV of finished goods, how can we find? Selling price minus cost of sale gives the NRV of finished goods. So formula we have to by heart: selling price minus cost of sale. Now NRV of work in process. NRV of work in process is NRV of finished good minus cost of completion, amount yet to incur to complete it. So NRV of work in process is NRV of finished goods minus cost of completion. And then NRV of raw materials. The NRV of raw material is found on the basis of the NRV of finished goods. So NRV of raw material. It depends on finished goods. If NRV of finished goods is greater than the cost of finished goods, the raw material NRP will be at actual cost. The raw materials are valued at actual cost. And if the NRV of finished goods is less than the cost of finished goods, then raw materials are valued at replacement cost. This is about the measurement of inventory. So measurement can be done at cost or net realizable value, whichever is less. Cost can be different types: purchase cost or direct cost, cost of conversion, and other costs. So purchase cost or direct cost is the cost amount we paid minus the trade discount plus non-refundable taxes plus all direct expenses. Now cost of conversion, there is labor cost and production overheads. Production overheads is further divided into fixed overheads and variable overheads. Fixed overheads, if the actual capacity is greater than normal capacity, we use the actual capacity, and if actual capacity is less than the normal capacity, we use the normal capacity to allocate the fixed overhead. And variable overhead is allocation will be based on the actual capacity. Then other costs are like selling, distribution cost and cost of design. Now we learned about NRV. NRV of finished goods, NRV of work in process and raw material. NRV of finished goods is selling price minus cost of sale. NRV of work in process is NRV of finished goods minus cost of completion. NRV of raw materials, which is based on finished goods. If NRV of finished goods is greater than cost of finished goods, we will measure the raw material at actual cost. And if NRV of finished goods is less than cost of finished goods, then raw materials are valued at replacement cost. Hope it's clear. Let's see an example. The cost is 90 and the NRV is 100. What will be the cost of inventory? The cost of inventory will be cost or net realizable value, whichever is less. What is less here? Cost, right? So the cost of inventory 90. Another one. Cost is 110 and NRV is 90. So cost of inventory is whichever is less among two, that is 90. Now let's see another example of fixed overhead. So the fixed overhead is 1 lakh and the normal capacity is 100 units and actual capacity is 200 units. We have seen the allocation of fixed overheads, right? If the actual capacity is greater than the normal capacity, we will allocate the fixed overhead on the basis of actual capacity. So let's see. What is the per unit cost? The total cost is 1 lakh divided by what will we allocate on the basis of whichever is bigger. Here bigger one is actual capacity. So to find the per unit, we will divide the total amount fixed overhead 1 lakh divided by actual capacity here 200. That gives 500 per unit. Now we have to absorption to product. Absorption to product is 500 per unit into number of units. Number of units we take the actual capacity. So 500 into 200, 1 lakh is the cost of inventory. Let's see another example. The amount, the production overhead, the fixed overhead is 1 lakh and normal capacity is 200 and actual capacity is 100. Here the normal capacity is greater than the actual capacity. So we will allocate on the basis of normal capacity. So per unit cost will be what? The total amount fixed overhead 1 lakh divided by normal capacity 200, that is 500 per unit. And absorption to product is 500 into what is the actual capacity? 100. So 500 into 100, 50,000. It will go to the cost of inventory. The total overhead is 1 lakh and the cost of inventory 50,000. So the remaining 50,000 will be added in P and L. So to absorb the fixed overhead, we have to see what is higher, actual capacity of normal capacity. If actual capacity is greater than normal capacity, we will allocate on the basis of actual capacity. We find the per unit cost by dividing it by actual capacity and absorb the product on base of actual capacity. If the normal capacity is greater than actual capacity, we will allocate on the basis of normal capacity. So 1 lakh divided by 200, so 500, and that will be allocated absorbed product 500 into actual capacity 100. Hope it's clear.